Picture this: a tiny tugboat suddenly generating a wake larger than an entire fleet of aircraft carriers. In yesterday's trading session, the global financial markets witnessed a 3 sigma statistical event, a phenomenon so rare that economic textbooks say it shouldn't exist. The Silver Exchange Traded Fund, the SLV, officially surpassed the daily trading volume of the king of liquidity, the S&P 500. This isn't a typo, and it certainly wasn't some intern at the exchange spilling coffee on the buy button. This is the sign of a cardiac arrest in the financial system. When a metal that Wall Street considers dead suddenly attracts more capital flow than the top 500 US companies combined, it means something deep in the underground structure has snapped. I need you to do something right now. Turn off the TV. Close that tab playing the comedy movies or the latest social media dance trends. Why? Because the most expensive comedy on the planet is currently airing live on the Wall Street ticker, and if you are not paying attention, the price of admission is your entire retirement savings. The data I am about to reveal is not a weather forecast. It is a treasure map inside a burning house. Where are you smelling the smoke from? Are you watching from a glass tower in New York, a basement in London, or are you calmly sipping coffee on a sidewalk in Tokyo with a gold bar in your pocket? Roll call your strategic position in the comments below. Let's see if the paper army or the physical army is winning the head count. To understand why this event is chilling to the bone, we have to strip the glossy paint off Wall Street and look straight at the rusting pipes underneath. Let's put these two entities on the scale to see the sheer absurdity of it. On one side, we have the S&P 500, representing the 500 largest companies in the American economy, with a total market capitalization of over $45 trillion. This is the vast ocean where the retirement funds of the entire world are anchored. On the other side, we have the silver market, a tiny, cramped puddle with a total global investment value of just barely $100 billion, smaller than the market cap of a single toy retail company. Yet, in yesterday's trading session, that tiny puddle generated a volume larger than the ocean. The SLV fund traded over 150 million shares in just 6.5 hours of trading. When you multiply that number by the notional value, you see a mathematical phenomenon that cannot be explained by normal logic. A niche asset, often forgotten, is being passed around at the speed of light. This is not retail investor interest. Your grandmother is not sitting at home buying and selling silver 50 times a second. This is the sign of the churn, or the meat grinder of high-frequency trading algorithms. Let's dive deep into the prospectus of the SLV fund to understand how this magic trick works. This fund does not operate like you buying a piece of metal and putting it in a safe. It is operated by a small group of elite banks known as Authorized Participants, or APs. Only these APs have the right to create new shares or redeem old ones. The mechanism works like this. When demand for the fund shares spikes, the price of the shares tends to go slightly higher than the actual spot price of silver. At this point, the APs step in. They short sell the fund shares to the market to suppress the price, and then they are supposedly buying physical silver to back the shares they just created. Sounds reasonable, right? But the flaw lies in the velocity of capital turnover. Data from the exchange shows that the turnover rate of a single ounce of silver in the SLV fund has now reached 356 times a year. That means, theoretically, the same bar of silver sitting in a vault in London has been sold to 356 different owners in just 12 months. This is the very definition of phantom liquidity. Why do they do this? Why create such massive trading volume that it eclipses even the US stock market? The answer lies in the concept of price control through liquidity. If you want to keep a beach ball from popping up to the water's surface, you don't need to hold it down forever. You just need to create a powerful vortex of water around it to disorient the buoyant force. The trading algorithms are buying and selling the same volume of silver thousands of times per second, creating a thick wall of orders. If the market were natural, when buying demand spikes, as we see from import figures in China and India, the price should go up in a vertical line. But here, the price goes sideways while volume explodes. This means only one thing in technical cash flow analysis. Someone is providing an infinite supply of paper at the ceiling price to absorb all buying power. But here's the problem. You can print money, you can create infinite derivative contracts, you can program a computer to short sell 1 billion shares in 1,000th of a second, but you cannot print silver. The system is trying to use paper to fill a physical thirst. The leverage ratio on the COMEX exchange has now hit 402 to 1. This means that for every 1 ounce of real physical silver in the vault, there are 402 people holding paper contracts believing they have a claim to that silver. Imagine a bank that has only one single $100 bill in the safe, but issues deposit slips to 400 different people. As long as everyone just trades those slips back and forth, the system works smoothly. But what happens when just two people, yes, just two people out of that crowd show up at the counter at the same time and demand cash? The event of trading volume surpassing the S&P 500 is the alarm bell showing that faith in this paper-passing game is shaking. Smart money no longer wants to hold the paper. They are trading at breakneck speed to find a way out, or to switch positions to a safer place. We are witnessing the great decoupling. While numbers on computer screens dance with trillions of dollars in virtual value, the physical stockpiles are evaporating. The market makers are trapped in the very liquidity trap they created. They are forced to trade faster, harder, creating even more volume to hide the truth that the warehouse in the back is empty. This anomaly is not a technical glitch. It is a feature of a system in its end stage. When a hard, finite asset like silver has higher liquidity than the biggest tech companies in the world, that is when you know that money is losing its function as a store of value and becoming a hot potato that no one wants to hold for more than 1 second. Forget the old stories about two cowboys in 1980. If you want to see the future of the silver market in the coming days, you only need to look at recent history. Specifically, look at March 8th, 2022. That was the day the London Metal Exchange, the cathedral of global metals, destroyed its 145-year reputation in a single morning. I am talking about the nickel blowout. On that day, the price of nickel doubled in just a few hours, hitting $100,000 a ton. A massive Chinese conglomerate, holding a gigantic short position, faced a margin call of billions of dollars, threatening to collapse the liquidity chain of the biggest Western brokers. And what happened? The exchange did something unprecedented. They pulled the plug. They closed the market for a week. And more brutally, they canceled all the trades that had been executed that morning. Billions of dollars in profit for legitimate buyers were wiped out with a pen stroke, just to save the short sellers. Why am I bringing this up when we are talking about silver? Because the current structure of the silver market in February 2026 looks exactly like the nickel market right before 0 hour. The explosion in silver trading volume surpassing the S&P 500 that we just witnessed is the sign of a nickel 2.0 loading into the chamber. The big banks, the ones holding short positions to provide liquidity, are trapped. But this time, their opponent is not a retail speculator. This time, the geopolitical chessboard has completely changed. Look at the East-West axis. While the West is obsessed with financial derivatives, the East is silently building a metal wall. China and India have realized that in a fractured world, Western paper promises can be frozen at any moment. Only physical assets sitting in your own vault are safe. Look at the physical flow data. In the last 12 months, the amount of silver flowing into Asian reserves has created a record deficit for Western supply. The silver vaults in London and the COMEX in New York are seeing inventory levels drop to alarming lows. This shift creates a dangerous paradox. The paper price of silver in New York is still suppressed, while the physical price in Shanghai is trading at a record-high premium, triggering an arbitrage trade that vacuums metal out of the West. When the London Metal Exchange broke in 2022, it only affected the stainless steel and battery industries. But silver is the people's money. Silver is the Achilles heel of trust in fiat currency. We are in a cold currency war. The West has printing presses and paper exchanges. The East has mines, factories, and real physical demand. And when paper trading volume hits a peak, like today, it is usually a sign that the short sellers are throwing their last desperate punches to hide the physical scarcity. But the buyers on the other side of the hemisphere, they do not care about the paper price. They just keep buying, buying, and buying until the warehouse is empty. History will repeat the nickel event, but this time, there might not be an exchange credible enough to stand up, cancel the trades, and save the system. Welcome to the era of artificial intelligence, where the tech gurus in Silicon Valley try to convince you that the future is built on glittering lines of code and invisible data clouds. But let me, a man who only cares about the flow of matter, tell you a naked truth. A truth that could blow this tech bubble right in our faces. AI does not eat electricity, it eats metal. And its favorite dish, the indispensable appetizer, is silver. Forget solar panels, forget electric cars, forget cruise missiles. We only need to talk about one single monster devouring the periodic table, the AI data centers. Have you ever wondered why NVIDIA's stock price went so crazy? It is not because they sell software. It is because they are selling the most exquisitely machined bricks of precious metal in human history. Look at the architecture of a new generation AI chip, like the Blackwell or Rubin series we are seeing in 2026. For a chip to think faster than a human, electrical signals must travel at near light speed without generating massive heat. And this is where physics slaps economics in the face. Copper, too slow and too hot. When you force billions of transistors to work at once, using copper turns that server into a toaster oven. Gold, great conductivity, no oxidation, but too expensive and too soft. You cannot build global infrastructure with gold unless you want a computer to cost as much as a small country. That leaves only one candidate: silver. Silver is the best conductor of electricity and heat in the physical universe we know. It is the blood of AI infrastructure. Every time you type a command into ChatGPT or generate a video with AI, you are activating trillions of calculations running through connectors, solders, and surface platings made of pure silver. AI servers do not just use silver in the chips. They use silver in the bus bars, in the power inverters, and in millions of contactors to keep the system from crashing. Look at this insane number. In 2023, the electronics industry consumed only about 20% of global silver. But by 2026, with the explosion of generative AI, that number has shot up to nearly 40%. Companies like Microsoft and Google are spending over $100 billion every quarter on capital expenditure. Where do you think that money goes? It does not float into the cloud. It goes into the ground. They are buying up every gram of industrial silver they can find to plate their server components. But here is the darkest part of the picture, what I call the curse of metal dust. Unlike the silver in silverware or jewelry that you can melt down and reuse, the silver in AI is dead silver. It is broken down into nanoparticles, coated in layers thinner than a human hair, buried deep within complex circuit boards. When an AI chip reaches the end of its life after 3 to 5 years, that silver is almost impossible to recover economically. It becomes e-waste. It gets buried. It disappears from humanity's stockpile forever. We are taking a rare, precious metal, digging it up from 2 kilometers underground, refining it at massive cost, only to turn it into dust and bury it back underground after a few years. Also, I can draw you a picture of a cat flying a spaceship. This madness is creating an unprecedented material thirst. The big tech firms are panicking. They won't say this on their earnings calls, but look at their actions. Why are tech conglomerates secretly signing offtake agreements directly with metal refineries? Why are they sending representatives to mines in Mexico and Peru? Because they know a secret. You can write 1 million lines of code in a night, but it takes 15 years to open a new silver mine. The growth speed of AI is exponential, while the mining speed of silver is flat or even declining. When these two chart lines cross, and according to my data, they just crossed this morning when that paper trading volume exploded, we will witness a supply shock like never before. There will come a time when having money won't buy you AI chips, simply because there is not enough silver left to conduct the electricity for them. Silicon Valley is betting everything on AI. But they forgot the most basic lesson of the real world. Software is infinite, but atoms are finite. And when the finite runs out, the infinite collapses. The silver trading volume yesterday was not speculation. It was the scream of an industry realizing that the blood vessels keeping artificial intelligence alive are running dry. We are standing on the threshold of the most brutal hardware crisis in history. And ironically, the world's smartest technology is being defeated by a stupid, cold, and ancient metal. So, after all the crazy numbers, the vertical charts, and the stories about AI factories eating metal like candy, the most important question right now is, what the hell do we, the normal people, actually do? Let me tell you a short story. Imagine you are at the most luxurious seafood buffet in the world. You buy an entrance ticket for $50. On that ticket, it clearly says, all you can eat lobster. You look around and see thousands of people holding the exact same ticket as you. They are excitedly buying and selling these tickets to each other. The ticket price goes up to $60, then $70. Everyone is getting rich trading tickets. But there is a small problem. No one is bothering to look into the kitchen. If they did, they would see that the chef left a long time ago, and inside the pot, there are exactly 3 lobsters swimming in boiling water. The event of silver trading volume surpassing the S&P 500 yesterday is the moment the crowd starts to smell something burning in the kitchen. They are passing those tickets around at breakneck speed, not because they want to eat lobster, but because they are looking for a greater fool to sell to before everyone realizes there are no lobsters. When you own an SLV fund share or a futures contract on the COMEX, you do not own silver, you own a promise. You are the owner of a lobster ticket. And in the financial world, promises are the cheapest thing, especially when a crisis hits. So what is the script for the coming days? I do not have a crystal ball, but I have history. And history usually teaches us 2 painful lessons. Scenario 1, the final shakeout. Do not be surprised if tomorrow or next week you see the silver price on the screen freefall. Maybe it drops $5, maybe $10 an ounce. Why? Because the big banks, the ones who short sold too much, need to scare you. They want you to think silver is trash. They want you to panic sell your tickets so they can buy them back cheap and close their positions. This is a classic psychological trap. If you see the price drop with no bad news, smile. That is a flash sale. Scenario 2, the unobtainium moment. This is the scarier scenario. The price on the screen stays still, but you cannot buy the actual metal. You call the coin shop. They shake their heads. You order online. It says out of stock. At this point, the paper price is meaningless. The real value of silver will be decided on the black market in private handshake deals, and it will be 2 or 3 times higher than the number you see on TV. So, what is my sincere advice from a friendly neighbor and not a financial advisor because I do not want to go to jail? Do not try to get rich quick. Do not borrow money to buy silver hoping to double your account next week to buy a sports car. That is a gambler's mindset, and the gambler always loses to the house. Think like a farmer storing grain before winter.